US CPI inflation data came in slightly lower than expected yesterday, but it was still too strong for the Fed to signal more than one rate cut during its policy meeting late on Wednesday. On the other hand, investors didn't believe the Fed, and they are still expecting 2 rate cuts by the end of this year, with the first one estimated to come in as soon as September. So let's have a look at what happened in markets, and let's start first with gold. We can see that the price rose as high as $2,341 after the release of the US CPI inflation data, but gains were limited, with the price falling, closing just below this broken support trend line at $2,325. This line looks to be the neckline of this potential head and shoulder pattern, so that is a negative signal that the price may follow a negative direction. However, there is another support trend line, constraining line around the 2290 level. That is the base of this range territory. So a close below that could confirm a bearish trend reversal. The technical indicators are also signaling negative bias. We can see that the RSI still it's below its 50 neutral mark, and the MACD keeps decelerating within the negative region and below its red signal line. So if the price falls below the 2290 level, I expect support to come next around the 2220 level. This has been a key support territory at the start of April, and it almost acted as resistance back at the end of March. So that could be another territory to watch before the focus turns to the 2185 level. Slightly lower than that, this support trend line coming from October 2023 could be another key territory to watch, currently seen around 2145. Now, in case the price climbs above the 2325 level, the 20 and 50-day moving averages could limit bullish actions around the 2345 level. Once again, above that, the 2345 territory could be also a key barrier. We saw the price falling aggressively after touching that territory at the start of this month. If the bulls successfully overcome that bar as well, then the next resistance could come somewhere between 2415 and 2430. This is where this broken ascending trend line is located, as well as this constraining territory which blocked bullish actions back in mid-April and in May. So a successful penetration higher above that could switch the outlook back to bullish, likely triggering a fast rally up to the 2500 levels. So now let's look at pound dollar. Pound dollar had a nice rally following the weaker than expected US inflation data, hitting a high of 1.2859, but it couldn't. But by the end of the day, it couldn't close above the 1.28 level. So that could be a warning signal that downside pressures are still in play. And the technical indicators are also signaling, are also in line with this narrative. The RSI keeps trending down within the bullish territory, approaching its 50 neutral mark, and the MACD is below its signal line, reflecting some caution within the market. So if today's weakness extends, support could come around the 1.27 level. This is the lower band of this bullish channel. So that could be a critical territory to watch. If the price closes below that level, then bearish risks could strengthen, likely driving the price into the 1.2650, 1.2670 territory, where this resistance trend line coming from May 2021 is located. Below that, another sharp decline could follow towards the 200 exponential moving average, and this pink constraining line coming from the end of December 2023 at 1.2570. Now, if upside pressure resurface above 1.28, the 1.2859 territory could come back into view. Successful move higher could stall near the 1.2915 territory, where this tentative ascending resistance line is located. Above that, this deeper ascending trend line could be the next obstacle, somewhere between 1.30 and 1.3020. And finally, looking at Euro Yen, well, the Bank of Japan meets tomorrow, so it will be quite interesting to see whether what is the plan for its potential quantitative tightening program. We can see that Euro Yen is rising for the second consecutive day. It's above this ascending constraining line at 169.65, so a close above it and above the 20-day moving average could confirm additional gains. However, looking to the upside, we can see that there is a tentative descending trend line at 170.78, so I would like to see a close above it, and more importantly a rally above the 40-year high 171.56 in order to target the next barrier at 173.45, where this longer term resistance line is located. That line comes from June 2023. Beyond that, there is another long-term ascending trend line, 175.25. That could be the next obstacle. Looking at the technical indicators, so we can see that the short-term risk is still skewed to the upside. The RSI has avoided a drop below its 50 neutral mark, and the stochastic oscillator seems to be changing direction to the upside. So upside movements are more likely than downside ones. Nevertheless, if selling pressures resurface and drive the price below the 168.80 support region, I expect another downfall to 167.50, where the 50-day moving average is located. Below that, well, there is another key trend line, 165.90, a break of which could probably push the price down to 164 and 164.50 territory, where the 38.2% Fibonacci retracement of this up leg is located, as well as this thin long-term ascending line coming from March 2023. So that's all about today's technical analysis. Thank you for watching, and see you next week. Bye bye for now.